In this video, we're going to talk about some of the pros, cons, myths, and misconceptions that go along with building a custom home with your VA home loan benefit. By now, you know that this is something that is very possible for you to do. And if you don't know, you need to go back and watch the first video that we did, which I will link above here, showing you all the steps that go along with making it possible for you to do the VA one-time close. This video is solely just to share some details, more of as a part two to that video that weren't covered. So that way you have a better understanding of what's possible so you can avoid making a very costly financial mistake. If you don't know who I am, my name is Joshua Payne, and we get calls every day from veterans just like you who are trying to navigate the VA loan process. So if you find yourself stuck and you want to get help from a team of individuals who specialize in helping veterans go through this process, give us a call or shoot us a text. All of our information is listed in the description down below. Okay, so let's talk about some of the pros and cons that go along with using your VA one-time close or building a construction loan. The first thing that I want you guys to really understand here is building a custom home or using the VA one-time close can be harder than buying a pre-existing property. And what I mean here is it can be harder for you to qualify for it because typically what I do see is someone who does apply for a VA one-time close but is also considering buying pre-existing property, they are actually going to qualify for more when buying pre-existing versus when building a custom home. And I'll get into that a little bit more here right now. When it comes to buying a pre-existing property, what you need to understand is the debt to income ratio. On a VA loan, there is technically no debt to income ratio associated with using it. The VA uses a little thing called residual income. Now, the VA does also not do VA loans. The VA only guarantees the loan, which means that they're the ones that are only there to determine who's actually eligible for the VA loan, which means that you must go to a lender to do a VA loan. And this same goes for a VA construction loan. Now, what lenders can do is they can add their own overlays on top of the VA loan to make it more strict. And a lot of times lenders do attach overlays specifically to debt to income ratio. When it comes to me and my team, we technically do not have a overlay for debt to income ratio when buying a pre-existing property with the VA loan. But if you are building a construction loan or doing a VA one-time close, we do have a debt to income ratio associated with it. If you're going to be building a property that is up to $766,000, then we are going to require a 55% or less debt to income ratio. If you're going to exceed $1 million, we're going to require a 50% or less debt to income ratio, which is the big reason for my example as to why I say it can be a little bit harder or more strict when it comes to how much you could qualify for with the VA construction loan. Now, the next thing that you need to understand is going to be credit score. Our minimum credit score for a VA construction loan is 620. But if you're going to buy a pre-existing property, it's 580. So there's a little bit of an example of a difference here. The other big difference here that I want you to also understand is going to be underwriting approval. When someone is looking at purchasing a property that is a pre-existing home on the open market, what we do is we have you submit your application, submit your supporting documents, and then we are going to review your income, assets, liabilities, and your credit to determine what you qualify for. What we do with all of that information is we submit it into an acronym known as AUS, Automated Underwriting System. This underwriting system spits out an answer based on a risk classification as to whether it wants to approve you for a pre-approval. Now, it's only a pass or fail grade, so it's not like you have it's not basing it on percentages. It's solely just pass or fail. What can happen, though, is the underwriting system may give it a fail grade just simply due to the risk classification, which it could be based on how high the monthly payment is based on what you're currently paying for housing, like rent. It could be based on your assets. It could be based on your credit, your payment history with things that are on your credit. There's a multitude of reasons as to what can cause this risk classification to give it a fail grade. But where I'm going with this is, in certain situations, even though it gave a fail grade, it does not mean a loan can't be done, or it does not mean that you wouldn't still actually qualify for a loan. You see, what can happen from that point is we can actually review your situation. match it up to the guidelines for VA loans, and look to see if you actually still do meet the VA's guidelines. And then what we do is submit your information to a physical, real life underwriter to do what's called a manual underwrite. And during the manual underwrite process, that underwriter is going to basically reconsider what the automated system stated. And I've seen many cases and had many situations where we were able to overturn what the underwriting system said by just doing the manual underwrite. I share all that to say this. Manual underwrites are not able to be done when doing a VA construction loan, which means you must be able to get an automated approval. So it now lowers the pool of people, or the amount of people that could fall into this bucket of potentially qualifying for a VA construction loan. The next thing that we're going to talk about is going to be different fees and expenses when it comes to building a custom home. When you're buying pre-existing, there is going to be closing costs, but you're also going to have closing costs when it comes to buying a construction loan or building a construction loan. But the other things that people don't consider, other than the fact that you're building a property, so you need the funds for that, also the funds for buying the land if you don't already own it, there's also things like a contingency fund, which is going to be for if there's any increases in lumber or labor costs during the time of your construction. There's some money left there as extra funds for being able to still purchase the funds or the material that is needed. Another one is a construction management fee. Because there is a lender that is actually funding the loan, they are going to also be in charge for managing the overall draws that the actual builder will pull to be able to build your property. So that management fee is really there for the entirety of the loan, that will allow the lender to be able to manage the build process. Now, you're not paying the management fee or the contingency fund throughout the time that your house is being built. This is a set number or a total number that's rolled into your total loan amount. Another one is going to be interest. You've heard me mention in my other video where I talk about VA one-time close that there is no payments during the time of your construction, which is true. You do not have to make any mortgage payments during the time of your home being built until the house actually has been completed. That's when you will make your first payment. But any interest that would have been accrued monthly over the life of the build process is rolled into your total loan as well. So just backtracking here, your contingency fund, your management fee, and also your interest is all rolled into the total loan. You even, if you want to, this is like, I guess you could say more of a pro to all of this, is you could even roll in your closing costs, which I'll talk about more later, to help lower how much you actually pay up front. But these are things that I just want to make you aware of before you catch yourself being a little bit more surprised by certain things as well. The next one is going to be if you are building a multi-unit or multi-family property with the VA construction loan, there are going to be some restrictions in which it makes it a little bit more strict as well. If you are going to buy a multi-unit property with the VA loan and it is pre-existing, what's cool is we can use the potential rental income that the property is receiving to help offset the mortgage payment, thus making it easier for you to qualify for buying that multi-unit property. When it comes to building one, though, unfortunately, you cannot count any of that potential income, which means you must be able to qualify for the full monthly payment, whether you're buying a duplex, triplex, or quadplex, which now makes it a little bit harder for you to qualify. The next one is going to be if you already own a property, whether it's with a VA loan or not, it actually can make things a little bit harder if that property is a property that you are living in right now. You see, when someone is buying a property that is pre-existing with their VA loan and they already own a property and they're living in it, what we get to do is offset the mortgage payment with what the potential rental income is. So for example, let's say you live in your house at 123 Main Street and you're going to go buy a house on 123 Main Avenue, right? 123 Main Street's mortgage payment may be $2,500 and it could possibly rent for $2,500. We now, instead of counting the mortgage payment of $2,500 against your ability to qualify for 123 Main Avenue, we get to basically offset it with the potential rental income to make it easier for you to qualify for the next property that you are looking at purchasing. This makes it a lot easier for veterans and homeowners to go from property 1 into property 2. But if you have a current residence that you're living in the same situation, but you're going to build property number 2, we actually cannot count the potential rental income. And here's why. When you are building a property with the VA construction loan, what happens is people confuse when the actual loan closes. Loan closing on a construction loan happens before any nail is hammered. It happens before any dirt is moved, anything like that, which means that the loan closes up front. That's how the funds become available for the builder to be able to build your home. So what happens is when you are closing on that loan, how you're qualifying looks is based on how you are going to be when the loan closes. So if we count rental income when the loan closes, but you're still living in the property, that's actually not true, especially if your house is going to take 6 to 12 months to be completed. So if you are trying to count rental income on your current residence, what must happen is you actually must rent the property out, go find a place that you can rent while your new home is being built. Here's what I want you to understand too here. You might still qualify. There are some people who do qualify for the property that they already own and live in, and then they're going to rent it out. If you want to still live in that property while your new home is being built, you technically can if you still qualify for the full payment, which means you just have to count the full payment against all of your other liabilities. It's not that it's impossible, it just makes it harder and has a smaller pool of people who could actually qualify for this loan. So now that I just finished talking about some of the pretty much cons to using the VA construction loan, let's talk about more of the perks as to why you should consider using the VA one-time close. The first one is going to be there is no second loan approval. When you are doing any other type of construction loan, what can happen is you have to have multiple loans in order to be able to accomplish your overall goal. You could be looking at a potential land loan, which could be very expensive for down payment as far as just being able to acquire the land. You could be looking at a construction loan. So now you have two separate loans that make it more expensive for you, and you're paying on both of those loans separately. In other cases, you could even finding yourself doing those two loans I mentioned and then doing a triple close, which means at the end of the construction process, you're now having to refinance those two loans that you had separately into one loan, making it more expensive because now you're going to have more possible closing costs. So there is no second loan approval. There is no triple loan approval. There's just one loan, and it's based on how you look before any nail or any dirt is moved. That's a very big perk that I would say sets the VA one-time close apart from any other type of potential construction loan that you might be considering doing. The next one I think is the coolest, is the float down option. When you close on your loan, as I mentioned before, you're closing up front before anything happens, and then there's no payments made until everything is completed. So your interest rate is actually locked in before you actually make a payment. Your interest rate is locked in at the beginning, just like when the loan closes. So for example purposes, let's say your interest rate is 7.5%, and then 12 months later, your home is ready to be completed, and the next thing your lender is going to do is about 30 days before that completion timeline, they are going to take a look at the current market to see how things are looking. And for free, we have the ability to float down your rate to the lower market rate if rates actually do go down. So let's say that 12 months down the road, rates went from 7.5 down to 5.5. Now that's a big jump, but just for the example, what happens is for free, you get the 5.5% interest rate, which means your payment is now going to be lower than you thought it was going to be when you closed on that loan. That's good news, right? But what happens if it goes the other way? What happens if rates go from 7.5 to 8.5 when it's time for your home to be completed? The good news here as well is you keep the 7.5. So you're basically getting the best possible rate based on the current market. That's another very powerful option for doing the VA one-time close. The next one, as I mentioned several times throughout this video, is there are no monthly payments during the time of construction. There's just only the total interest rolled into your total loan, but the monthly payments are not made until after your home has been completed. The next one is going to be customization. You get to pick your design. You pick what you want. You get to basically decide what you're looking for in your overall home versus buying, as we call it, a spec home that is just on the market that's similar to everyone else in your possible neighborhood that you're going to be living in. The next one is closing costs. You can roll in your closing costs into the loan, and here's how this works. If you are building a property on the VA construction loan, what can happen is they're going to do your appraisal based on the land value and based on the potential completion value. So what they're doing is basically doing like a forecast to appraisal of what the house would be worth. And a lot of times what can happen is the actual appraised value is going to be higher than your loan amount, which means that you basically have equity there. This is very powerful for you because you have a home that's worth more than what you actually owe on it. With that equity, you could roll in your closing costs to that to be able for you to not have money that you're bringing to the table at closing when you close on that house versus someone buying pre-existing. That's not necessarily an option for them, that unless they're going to get seller credit to be able to cover those closing costs for them. So this is a very powerful strategy, I guess you could say, for building a custom home. And then the next one is going to be flexible construction options, which means that similar to the customization one, when it comes to flexible construction options, where I'm going with this is if you are basically owning a property that maybe has an old building on it, and you want to basically demolish and renovate by redoing the entire thing, you can. Sometimes people think that it's only for buying land or having raw land and you're going to build on it. It could be for those of you that already own a dwelling that maybe is just old due to age or maybe natural disasters of some sort. You can use the VA construction loan to roll in the demolition costs and rebuild towards your actual new home that you're going to be building. So another really cool option there as well. The last thing I want to talk about is who should or should not do the VA one-time close. Personally, I do not think that doing a VA one-time close is going to be for the first-time home buyer that is just looking at building a single-family home. And the reason for this is because the average American moves every 5 to 7 years, which means that building what you might consider your dream home, especially with it costing more than it would to be able to buy a pre-existing property, I personally just believe that it can be something that is more expensive and actually hinder your overall long-term financial growth. This is not me saying that it's a completely bad decision for you. I'm just thinking of it as it's not the best decision. Most people that are building a custom home are building their dream home and also their forever home. Now, if you're looking at using the VA one-time close to build a multi-unit property, that's a completely different strategy because you're obviously buying it knowing it's going to be an investment on day one. You're just going to live in one of those units and rent out the other units to offset the mortgage payment. That's a completely different point that I'm making for the first-time home buyer when it comes to buying a single family home or building a single family home. Another thing that I want to make very clear that I think people actually mistake with the VA one-time close is thinking that it's actually going to be more affordable or cheaper than buying pre-existing. And that's just not true. A lot of people have this fun, large list of pictures on their Pinterest board with what they dream of, and then they fail to realize that building a custom home can cost more than pre-existing. It not only can, more times than not, it does. You see, typically, depending on where you're located geographically, the average cost per square foot that I have seen for building a property can be anywhere between $150 to $400 per square foot, which means that depending on where you are, the cost on just construction alone can be anywhere between $300,000 to as high as $800,000, just basing it on average cost or average size of someone's home. This is not to deter you or tell you that you're making a bad decision. This is just more to be very transparent with you as to things that I want you to be prepared for before you actually embark on going through this process.